Hi guys, welcome to my Binance tutorial for beginners. We're going to go over how you set up an account, how you get the security right on the account, and how you first deposit some money onto that account. We're not going to go into too much depth on how to trade, but we are going to touch on it so you can see the difference between the spot market and the futures market and what you can do and what it all means. And then we'll also have a look at the Binance trading bot at the end. There'll be timestamps in the description for you to use, and I'll also put a link down for the Binance sign up as well, so you can get 10% off your fees for all your Binance trades. If you haven't already subscribed to the channel, please do, and if you enjoy the video, then give it a like. Enjoy. Okay, so this is Binance.com. If it's your first time on the platform, then up here we'll have login and register, and you click on register and go through that process. Depending on which country you are registering from, it can be a little bit different because you depend on what form of ID you'll need to set up the account. You're going to need some form of ID to go through the KYC registration part, whether it's passport or driving license or whatever it is, depending on where you are registering from. Once that is done, if it is your first time in crypto and you haven't got any funds in any other wallets that you can transfer across, then you can come up here and buy crypto. Now you can come on to the credit or debit card bit here. Tells you the current price of Bitcoin in US dollars, and you can select whichever whichever currency you want to transfer across. Then it will change the price of one Bitcoin to represent that. And as you can see down here, there's a reoccurring buy as well. So you can set that up so it deposits crypto into your account weekly, monthly, however frequently you want to set it up, and it will just continuously do that straight out of your bank account. And then in card deposit here, if you just wanted to make a one-off deposit, again you can select the currency that you want to deposit up here, and if you can see here, there's a 1.8% fee, and that's because you're sending it over from Visa or MasterCard into the account, so there's a much higher fee. Once you've got money in your wallet, then transferring it between your wallets is, it's relatively cheap. If you're doing it on the Tron platform, for example, then you'll only be paying $1 per transfer, no matter how much you're sending. If you're doing it on Ethereum, it may be ridiculous fees because Ethereum fees are very high at the moment, but that is something that they're trying to work on and bring down. But the fees are going to be a lot lower when transferring money between your wallets when you aren't using Visa or MasterCard. So, but obviously, in the first instance, you need to get money from your bank into crypto. So you've got to go through it somehow. There are platforms available where you can do bank deposits where the fees might be a little bit lower. So it's worth having a little look around and seeing what you can get. So once you've got some money on your account, first thing I recommend we do is go down to security and make sure you've got your two-factor authentication set up. Now, you can either do this where they'll send you a text message when you're logging in and an email, and you'll have to put in the code, or you can use Google Authenticator, and you can have an app on your phone with Google Authenticator, so you can authorize every transaction that is going through your Binance account. Then up here you've got loads of different options to choose from. If you just went onto markets, then it will just show you information across all the markets, and you could come down here and select which one you wanted to trade if you'd so wish. But what I'd suggest is you come down onto the advanced trading tools here. This just means that we are using trading tools provided by TradingView. It just gives you a lot more information. Get rid of these trend lines, and I'll get rid of those for a moment. So this is what you'll have come up. Up here we've got the trade pairing, which is at the moment Bitcoin and US dollar Tether. You can click through and change which coins you want to be looking through, either at the top here by what you have on account to trade it against. If you've got USDT on account to trade against, then you'll want to go through USDT. If you've got Bitcoin on account to trade against, then you want to go through that. So this is trading BNB, Binance coin, against Bitcoin. And you can also then favorite them, unfavorite them, and then they'll all appear in your favorites list there. So that makes it a little bit easier. It can make it a little bit easier as well. Then you've got the price here, and you've got the change of price in percentage here, and we can put the lowest to the top so you can see the biggest loser of the 24-hour period, or you can put the biggest gainers of the 24-hour period at the top there, and then you can see that DAI has gone up 50% in the last 24 hours. Or you can click this little button here and it shows you how much volume has been traded against them in a 24-hour period. So you can see nearly 2.7 billion has been traded against Bitcoin in the last 24 hours. So on the Bitcoin chart here, you've got the price in US dollars at the top, and then you have got it in whichever currency your account is set up against. So I'm in the UK, so I've got Great British Pounds there. And then it tells you the change in 24 hours. So we've got the numerical value there in dollars. So it's gone up $2.4 thousand in the last 24 hours. And then it's got the percentage change. So it's 7.12%. This is the 24-hour high. So the highest that the price has been in the 24-hour period. So you can see up here, it went up to 37,550. And it has also been down as low as 32,917 down here somewhere. Then it tells you the volume that's been traded in Bitcoin. So there's been 76,000 Bitcoin traded in the last 24 hours, and the volume in USDT, so nearly 2.7 billion in USDT. Then up here, we can change the time frame. So each of these candles represents, each of these candlesticks represents a length of time. So we're currently set to 1 hour. So in 1 hour, the price went from down here all the way up here to close, and then the wicks are showing us the highs and the lows. But then you can change to 4 hours, 15 minutes. We've got all these choices here, and you can also come onto here and select which ones you want to look at. So we can look at 3-day if we really want. And that would be the 3-day chart. You can also add technical indicators. I'm not going to go through what all the technical indicators do now. Well, I would never go through what all of them do because it's a ridiculous amount, but the ones that you might use more frequently, so you can add them on there, and then once they're on, you can hide them and show them here. Go into them with the little settings button there, change the length of like this one's set to 200 candles, change the color, thickness of the trend lines, and yeah, that's a very helpful tool to have. You can select which candles you want. Like you can have bars. Don't know why anybody would want bars, but some people do like the Hakini Ashi candles because they reckon it's easier to see the trends, and it blocks out a lot of the noise. Like if we take this rise here, for example, or this rise here, so it just shows all green going up. But on a normal candlestick, there'll be some red, and it just blends it out a little bit so you can see the trends easier. It doesn't give, I don't think it gives us much information to use for trading, so I stick to candles, but some people prefer them. And we've also got the drawing tools down here, which TradingView provides. And like you can add in your own trend lines, for example. I could stick a trend line down here because it keeps bouncing off up there. You could stick a trend line down here. Or you can go through those and use whichever ones you like there. And then along the side we've just got the price going up and sort of different values, and you can also change that if we come down to a smaller time frame, easier to see. So you can see the price from where I put this bar here was down at 33,700, and up here we can see like 37,571. But if you wanted to know what that was in percentage, you can see that it's gone from like 0.5% to 12%, so you're talking 11.5%, and this can be very helpful for working out your trades, where you're going to jump in and out of trades, because you can see where there's more volatility. If we went on something that has had a big jump today, like DAI, you can see where the volatility is. So if you were trading up here at the moment, buying in at the lows, it says you're at it's plus 40%, selling only just up here. So what are we on, 15-minute candles? So you could have bought down here, you can buy down here when it's come down from the red, jumped back up, and you're talking difference of 43, 12% gain just there. So the percentage thing can be very helpful for day trading. You've also got on here, it's very useful for charts things, so you can set up 4 different charts, so you can monitor a few at once if you haven't got multiple screens set up. And again, you can choose which time frame you like to trade off, and then you can just monitor and wait for your entry points for trading. And just go back to one chart. Over here we've got the order book. So what we've got is you've got all your bids down here in the green, and all your offers or asks in the red up here. So this is basically like all these people are selling, and they're putting the price of what they're selling for here, and all these people are buying, but they are putting the price of what they want to buy for here. And then in the middle we've got the current price, and it shows me what it is in my currency as well there. So this is the price that the offer is, of what they're asking you to buy it for. This is the amount that is available to trade at that price, and then this is the total value of it there. A little bit further down, these are the trades that are coming through at the moment. Obviously this is Bitcoin that we're trading on here, so it's very volatile. There's lots of trades coming through, so you can see by second there's tons of trades coming through. But if you went onto something that didn't have the same sort of volatility, this ACA, it's not started trading yet, but SUSD, I don't know what it is, but it's volume, it's trading volume for the last 24 hours, only 180,000. So you can see it's a lot slower. There's no movement on this order book. So that brings us nicely onto the spread and what the spread is. So here we've got the bids of what people are wanting to pay, and up here we have the offers or the asks. And then so if you went in to buy, you wanted to buy, and you took that 1.002, which is the next available price, then you are straight away going to be down, because the next buy price is 1.000. So the gap between the bid and the offer we call the spread. It's not going to be very big in crypto because there's not huge spreads. They're normally quite volatile. This is the sort of closest you're going to see because there's not much activity on this sort of these smaller coins. Bit of a bigger one there, but still not very much. But realistically, you're not going to be probably not going to be trading these sort of coins. We're going to be trading the larger coins, and the spread is irrelevant because you can see how little there is between them when it stops flickering around. So but no, it's good to know. It's good to know. Okay, over here, so we've got where we buy. So you see you've got buy and sell up here. So we're looking to buy Bitcoin at the minute. Up here you can put in the price and you can select what price you want to pay. Now this is because you're on a limit order. If you're on a market order, you wouldn't have the price. It would just take the next available price that's available. So the next offer that was available, the market price would just take that. So if you're on a limit order, you can click I want to buy it at this price or this price, and it changes it on here, or you can manually put it in. So, I want to put it in at 35,000. Put in how much you want to buy, and then it will tell you how much it is in USDT here. And then when you post this, it would appear in your open orders here, and it will be wait for the price to come down to 35,000 before it buys in. Whereas if you wanted to do a market order, then you're just taking the next available offer that's on here, and you can only pick how much you want to buy. You can't see the price because it will just make that value up once it pulls the offer, and you can literally just ask for the price on there. So that's limit and market orders. Now if you are doing a limit order, your fees are going to be less than if you're doing a market order. If we go over to the fees here on spot trading, so what you've got is you've got makers and you've got takers. So if you are doing a limit order, then you are making liquidity. You are putting an order onto the order books to make liquidity. Now if you're doing a market order, you are just taking the next offer that's available. So you are taking liquidity. So the fees are there to reflect that. Now you can see here, if you're on the very basic, then you're just going to be paying 0.1% for your maker or taker. But as you got more money on account, the fees will be better for makers rather than takers. And when we go on to futures in a moment, you'll see that the futures fees are better for makers compared to takers. On that as well, it's worth noting that if you've got BNB on account, because we're using Binance Smart Chain, then they can take the fees in BNB, and you will pay a slower rate because of that. Also, if you sign up for a referral code, you may get a percentage off your fees based on that referral code, on how much you will actually pay for your fees then. So you could pay less if you've been referred by someone else. On here, we've also got post only. So post only is basically, it will only appear if it goes onto the order book. So if you're making a maker rather than a taker, so if you're gonna put on, say, 37,000, and you put post only and then put buy Bitcoin, it would just cancel that order because it wouldn't go onto the order book. But if you were gonna do 35, and put post only, then it goes into the order book. You're then paying the maker fees rather than the taker fees, and it's just a helpful little thing to extra to have. And then an iceberg, if you're doing huge amounts of sales, if you're making a huge volume of sales, like you're talking like 50 bitcoins worth or something like that, then it will split it down into smaller purchases or sales, so not to spook the market or anything, and it will just spread them out a bit further. Maybe sell a little bit at 36,300, sell more at 36,200, sell more at 36,400. Break it down a little bit, because you don't want to force the price down and force the price up by doing huge amounts like that. And then your stop limit can be very helpful if you're going to buy Bitcoin now, for example, because you think it's going to go up and the price actually comes down, then you can protect yourself from that. So, we'll say we've set up a market order, we've bought 0.1 Bitcoin, it's there, we've got 0.1 Bitcoin, come over to sell, go on to stop limit, and then you'll put your 0.1 Bitcoin and you can say the price that you want to sell it for. So if the price came down, I don't know, 2%, or like down to here, just below here where the lowest it's been before, so you could say 2%. You can put a little line where 2% would be. And then that would give you the value 35641. So you could see when it gets down to 35641, we want to sell it. So the stop is where it gets to. So you could say it won't activate this sale until it gets down to it. But you could say, like, if it gets down to 35 641, I want to sell it for 36. It will put a limit order in to sell it at that price. And it's just a helpful thing to do, so that you can, if you go to bed or something and then the price just falls away from you, you know that you've got that stop limit, so you're not going to lose everything. You just can control it like that. Okay, and then if we go up to here and come down to derivatives, so you've got a couple of different derivatives. You can basically, it depends on what you're using for your leverage, but we'll come on to it and we'll go through it. So if you go on to the USD leverage, and then it's all a little bit different. So basically now what we're doing is we're trading futures. So when you're trading futures, you're not actually buying any form of crypto. So here we've got Bitcoin USDT. We're not actually buying Bitcoin in this. What a futures is, it's a synthetic contract, and you're basically betting on which way it's going to go. And when you're betting, you're using what money you have on account as collateral to do so. So if you go long, you think the price is going to go up, and you go long, open a long position, you're betting that the price is going to go up, and if it goes down, then the money that you have on account will be used as collateral, and it will be taken if the price goes down. So if the price goes so low that you run out of collateral, then your position will be closed and you'll lose everything that you had. So you're going to need to ensure that you either top it up if you think that, it is going to go long, or just be aware of how much you are putting on. But it's a little bit different. So again, we've got your Bitcoin, your trade pairing up here, and then we've got two different prices here. So we've got your mark price and your index price. The difference is you've got like your funding rate here. So when you're doing futures, if you're going long, then you have to pay a funding rate to the people that are going short. So if you're going short, you're getting paid this funding rate by the people that are going long, and then that just the index takes into account the funding rate. So the mark is the price, and then the index is the where it taken into account the funding rate as well. And then that's paid out every 8 hours, and there's the countdown to the next payout. Other than that, all the information that you see at the top is the same, and we have the same, trading view information here. We've got your order book again as normal, and the trades down here, but then it gets a little bit different around here. So here we've got you can choose between the cross and the isolated. So the cross, it basically uses all of your available balances to use against the margin requirements. So any value that you have on your account could be used as collateral for the losses, for any losses that you get. Whereas the isolated is the margin is only applied to each position individually. So you won't use your entire amount of your account for collateral, just what you want for that individual trade. And then on here, you've got your leverage. So you can see that you can trade just 1 for 1 as you normally would, or you can go a ridiculous amount and go up to 125x. So obviously that's insane. Most people just stick to 1 to 5 max. Some daredevils might take it a little bit higher, but I think you can go to 20 times leverage when you first set up an account, and then you have to wait to have been trading for a certain amount of time to go any higher than that. But then that's how you'd use that. And then the process for limit market orders is the same, but you've also got this take profit stop loss here. So this is what I was saying earlier about the whole percentage chart on here can be very helpful. If you're doing short-term trades, you can see, like for example, our highs have been up here, 3.88, lows down here. So you know the sort of area that you're trading in. So you could go, I want to buy however many Bitcoin at this price, and then you could say, I want to take profit when it gets to that next percent there, so there's 1, and then I want to have a stop loss in place, so if it goes below that line there, so let's say 0.5. This is just an example of using this chart that we have here, and then it will fill in the price there, and then you can create here. Now one thing that we do have on futures is we don't just have to go long, we don't have to say that the price is going up. We can go short as well, so we can bet that the price is coming down. So if you're doing that, then you change this over to short, and again this one you just be betting that the price is going to come down 1%, and the stop loss would be if the price went up another 0.5%, it would stop it out, cancel the order, and you'd just have the small amount of loss compared to what you would have done if you just left it running. And you can do your trailing stuff on this, which is great. So let's say we were down here, you saw that we were coming down to do it on 4-hour chart, might be a bit easier. No, 1-hour chart perhaps. Yeah, so we're down here, you can see that from previous that it had bounced off this sort of area of resistance, and you might go, right, I want to have a bet on the price coming back up. You could have gone long down here somewhere and then put in a trailing stop loss. So what this means is you can put in what you want to, 0.5%, but the trailing stop loss, as the price goes up and up and up and up and up, the stop loss follows it. But as it comes down, so it hits a red candle and then the price dropped there, the price of the stop loss doesn't follow it down. So the stop loss goes up to the highest point, and then if say you've put a 2% stop loss on, as the price comes down another 2%, then it would have been stopped out. It just means that, if you think you're going to have a runaway, you don't know how much you're going to have. You could have put on, I think it's going to go long here, I'm going to take 5%, But in this example, it went up much more than that, and you can actually get better gains through using a stop loss. Obviously, it doesn't always work, because if you went down first, then you get stopped out straight away. But it's an extra tool there for you to use. Okay, let's just do an example then. So we are going to just put that down to 5. So there's not much money on the account anyway. Just go $50. We were going to go, bet the price is going to go back up. So we're going to go long 0.5, stop loss 0.2, and then press go long. So we're on a market order, so it will have taken the next available price there, and it puts it down here. So here's our position. Here's how much that we've got on, the entry price that we went in, the price that it is now, and then it tells you your profit or loss. But what it's also done is that you can see here, it's opened up 2 orders. So we put in a stop loss and a take profit, stop loss, and it's put in to cancel this order, either taking the profit when it gets to 36,471, so up here, or closing it and taking the loss so that it doesn't go any further down than wherever it was down there. So it's worth noting that's how that works. And then if you wanted to close, you can close by market order or close by limit order here, and just close out them positions. And then you can also look back through all your transaction history over there. I'll close that because that was just an example, but obviously you'd paid fees on that as well, so don't just jump in and out. Make sure you work out how much fees you're going to pay to how much percentage you're going for. 0.5s, 0.2s, there's very little movement there with around your fees. So if you have a equal amount of fee wins to loses, then you need to work out if you're making enough profit with that percentage rate. Right, so that was your USD futures. So all that meant was that we're using the USD on account as collateral. So if the price comes down and you think it's going up, then it will just reduce the amount of USDT that you've got on account. Whereas you can also come over to Coin M, where you'd use Bitcoin. Now, it's worth noting that if you're using Bitcoin, then if you for example, if you're doing USD, then you know that the USDT is a stable coin, so it's going to stick to the value of the dollar. If you're doing Bitcoin and you're betting that the price is going long, but it actually comes down, then you are losing it. So you're using your Bitcoin as leverage, but the value of your Bitcoin is also reducing as well. So it's worth noting that you could get stopped out quicker than what you expected, because the value of the Bitcoin will drop as the price drops. Whereas if you're using USDT, we know that USDT is stablecoin tethered to the price of dollar, so that's one less risk to take, because you know that the price is going to stay where it was, stay at $1. You can see on here that you've got one thing I didn't mention. You've got perpetual futures, so that basically means that they go on forever. But you can also do quarterly ones as well. So if I click on this one here, it says quarterly 25th of the 3rd. So on the 25th of March, then this one will end, and whatever you have on your account at that point your positions will close at the end, at that end date of the 25th of the 3rd. And then again here it tells you how long's left for it. Another thing is we've got a calculator here, so on the futures it can help you work out how much money you're going to make basically. So we entered this one at 36,000, Our exit price is 40,000. We put in 1,000 US dollars. We did it at, come on, there we go, 3 times leverage, and then it tells us how much profit we would make from that trade. So yeah, can also be helpful if you want to use that. Up here we've also got Spot Grid, which is basically where you can set up a little trading bot. So how a Spot Grid will work, you pick your lowest point that you want to trade, so say down here at 35,500, and then your highest point will go 37,500, and then it will basically set it up to trade in between that area for you. So as the price goes down, it will buy, then as it comes back up, it will sell. And then depending on how many grids you do, if you do, it says here you can do 2 to 45. So if you did 2 grids, for example, it would just buy at 35,500 and excuse me, sell at 37,500. But if you put in 45 grids, it says I could only do up to 26 because the difference is too small. But so we'll do 26, and then basically what that means is it would put in a grid at like 35,500, 35,600, 35,700, 35,800, and then every time it hits one of those coming down, it will buy, and every time when it hits one of those coming up, it would sell. And then you can put in a stop loss and a take profit on this as well, and a trigger price of when you want it to start. If you didn't want it to start straight away, if you wanted it to start when it gets further up or further down, then you could put the trigger price in there. And then at the top here, you've got your arithmetic and geometric. And all that is that in the arithmetic ones, the grids will be evenly spaced based on the price. So like in our example, we were saying every $100 in between each one, it would have 100 between each one. And then the geometric one would be equally spaced based on ratio. So that would be like the percent. So you'd have 0.01% difference, which would mean that as the price gets higher, it would get slightly bigger in difference, if you understand what I mean. But yeah, it'll be the percentage difference rather than the price difference. You can also go onto futures grid, and whereas on the spot grid it will just buy the lower price and then sell as it goes higher, on the futures grid it will buy at the low price and sell higher, but it will also sell at the low price and buy back lower, so you can go along and go short on it. You can set up an automatic one if you want, but if you come over to the manual, then you can put it as neutral, so it will have the same amount of grids buying as there are selling. Or if you think that we're going in a bull market, then you can go long, and then there'll be more buys to sells, and obviously shorting it is just the opposite round. It's just going to be more focused towards the price going down, or in the long, the price going up. But other than that, it's exactly the same as on the spot grids. But in your lower price, you've got more a higher choice of grids on here as well, which it makes it more useful. But yeah, those two are just a little bit of extra for you to enjoy on Binance. It's nice, you can have a bot running in the background trying to make you a little bit more money. Obviously just be aware that when it goes out of your range, then you could just get stopped out. Okay, so that's it. So there's a lot more things on Binance to do. You can have a look through them if you wish, but then these are the most important bits for your day trading, whether you want to do it on the spot market or the futures market. I personally prefer the futures market because you can short as well, and being in a bear market at the moment, it's a lot more advantageous than the spot market. But yeah, hopefully that the information I've given you
helps you understand the basics of how to use Binance.
Thanks for watching, guys. I hope that was informative and it's beneficial for you. If you enjoyed the video, then please do give it a like. And if you haven't already subscribed, then please subscribe. Don't forget, there's a link in the description to sign up to Binance, and happy trading.